If you clicked on this video, that means that you, like me, are probably at least a little interested in growing the amount of money you have into something bigger. Maybe, like me, you're interested in the stock market as one way to potentially make that happen, but you're also a little nervous that you could lose a lot of your hard-earned money that way. That's, a reasonable fear. I'm personally interested in financial independence, but I'm also quite risk averse when it comes to money. That's why this opportunity is so interesting and particular to me. In this video, I'm going to talk about one specific way to invest in the stock market with 100% downside protection, or in other words, without the chance of losing money. If that sounds too good to be true, good. That means you're approaching this and other advice with a healthy degree of skepticism, which is important in general, I think, but especially important when it comes to dealing with money. There are, so many resources out there promoting get-rich-quick schemes, which are, almost certainly scams, and that's not something I'm going for here. On that note, I would actually prefer if you stay skeptical while watching this video and come in with a critical eye. And, by all means, call me out in the comments if I get something wrong here. You can then, make the decision for yourself about whether this makes sense for you and your personal situation. I'll break this video down into a few parts. First, I'll cut right to the chase and tell you what the specific opportunity is. Then we'll get into a little details on how it works. And then we'll talk about, what are some of the potential trade-offs you might want to consider. Okay, so first off, what the opportunity is. About 3 weeks ago from when I'm recording this right now, a group called Innovator ETFs launched an ETF called the Innovator Equity Defined Protection ETF, or TJUL for its ticker name for short. For a super quick explanation of what an ETF is, for those who don't know, ETF stands for Exchange Traded Fund. What that means, is that it's an investment fund that can own financial assets like stocks and bonds, but similar to like a single stock, is traded on a stock exchange. So you can buy and sell individual shares of ETFs throughout the day. Under the hood, TJUL is tracked to the S&P 500, which is a well-known stock market index that tracks the performance of 500 of the largest companies listed on stock exchanges in the United States. Generally, investing in an index fund that tracks to the S&P 500 is well regarded as one of the best and safest ways you can invest your money. There are a lot of financial experts you can turn to who will back up investing in the S&P 500, but just to pull out one example, Ramit Sethi, author of I Will Teach You to Be Rich, said recently, "We often believe that rich people have access to secret investments, and that's how they make a ton of money. Listen, I have access to these investments, and I can tell you right now, they typically do not perform better than a simple S&P index fund." Historically, the S&P 500 has done very well. Since its inception in 1957, the average annualized return rate has been 10.15% all the way until 2022. This is, a fancy way of saying that if you had invested your money back in 1957 and then not touched it at all until today, it would have grown on an average rate of 10.15% every single year until now, or until the end of 2022. If you had invested $100 back then, you would have $58,406.66 today. The key part where TJUL comes in is this notion of average. Over time, the S&P 500, performs very well, but year to year, the performance can be volatile. In 1995, for example, the rate of return was, I believe, 34.11%. So if you had invested at the beginning of that year and then let that sit and then withdrawn at the end, you would have had a pretty good growth on your investment. However, if we look at a year like 2008 when we hit a recession, the rate of return was, I believe, negative 39.32, which is a major loss. Again, over time, the S&P 500 would historically make you a lot of money, but you can have very positive and also very negative years along the way. TJUL protects against this volatility as it's designed with 100% downside buffer over a 2-year outcome period with a capped outcome. What this means is that over the course of 2 years, if you invest on day one of the TJUL, then don't touch your money for 2 years and then withdraw on the final day, even if the S&P 500 completely tanked in value, you should not have lost any money. On the other hand, if the S&P 500 goes up, your investment should go up as well. Here's a visualization of hypothetical outcomes that can happen. As you can see, in the case of significantly negative, generally negative, slightly negative outcomes for the S&P 500, TJUL should remain basically unchanged. In the positive outcome for the S&P, TJUL should also be positive. So far, I would guess that this sounds pretty appealing. It certainly was for me when I first read up about it. However, there are a few trade-offs that are worth keeping in mind here. I personally still think it's very much worth it, but I think everyone should go in with the clearest idea possible of what they're getting into, so let's dive into all that. The first is that capped outcome I mentioned earlier. In order to get that 100% downside protection, you have to give up some potential upside. For TJUL, the cap on returns is 16.62% over the 2-year outcome period. So as long as the S&P goes up, TJUL and consequently your investment will go up as well. But if the S&P goes beyond 16.62% over the 2-year outcome period, your return on investment will stop at that 16.62% increase, and you will lose out on any of the extra gains you would have had if you had just directly invested in a fund that tracks directly to the S&P 500. The way that I sort of reason through this is through another visualization, another graph. With traditional investment in the stock market, your outcome is entirely unbounded. You can, lose literally everything you put in. You can have, I guess, theoretically infinite growth. Your money could grow literally forever. So you could have very bad, very good, and everything in between as possible outcomes. With the TJUL, you're shortening that range of potential outcomes a lot on both ends. You eliminate all of the bad and you get rid of a lot of the good too, which leaves you with neutral to, the low end of pretty good. Another caveat to keep in mind is this 2-year outcome period. Innovator ETFs, the group behind TJUL, says there is no guarantee the fund will be successful in providing the sought after protection. If the outcome period has begun and the underlying ETF has increased in value, any appreciation of the fund by virtue of increases in the underlying ETF since the commencement of the outcome period will not be protected by the buffer, and an investor could experience losses until the underlying ETF returns to the original price at the commencement of the outcome period. Because, the downside protection is based off of the starting price, if you, instead of at the starting price, you buy at a higher price than that, and then at the end of the 2-year period, if it goes back down to the starting price, you'll lose that difference in money. Luckily, as of recording this video, the price of TJUL is not higher than when it first launched about 3 weeks ago. So you would be good if you invested today, but that obviously is not necessarily true for what happens in the future. The 2-year period also means that in order to get that protection against losses, you need to stick around until the end of those 2 years. By all means, if the shares have risen in value and you want to take your money out to realize the gains, you're very well welcome to do so. There's nothing stopping you. But, in the middle of that period, the price can go below the original price you bought it for. It's only at the end of the 2-year period that you're guaranteed that the price will be the same as the starting point or higher. Another factor to consider is, as I mentioned I think earlier in the video, this is a buffer ETF, so it doesn't exactly move in a one-to-one relationship with the S&P 500. Buffer ETFs are resistant to volatility, so if the S&P 500 goes down and goes down very quickly, the TJUL will go down, but not as much or as quickly. Conversely, if the S&P goes up, TJUL won't go up as quickly. If you're interested in learning more, about buffer ETFs, I added a link in the description that goes into much more detail than I went into right now. Last is the expense ratio. This is the percentage of your investment that innovator ETFs will take out as, basically you can think of it as like a management fee for your account. You'll, generally see this type of thing for most kinds of investment. The percentage for TJUL is 0.79%, which, while not incredibly high, is on the higher end for ETFs in general. This means if you invest, like $1,000, $7.90 will go to fees. Generally, fees above like 1% or 1.5% are considered deal breakers by a lot of people, and this is below that, but I still think it's something worth, considering here. That's, all I've got on this one. As far as stock market opportunities go, I think this is a pretty compelling one, especially if, you're aiming at making like a big purchase in a couple of years and aren't willing to take on a lot of risk. I've tried to outline every possible trade-off that I think is involved here, but definitely let me know if there's something I missed here. I honestly usually make videos on tech, but I find personal finance interesting, so if that's something that interests you as well, feel free to let me know and I can consider making more videos about it in the future. As always, if you enjoyed this video, feel free to like it, and if you want to see more videos from me, subscribe to the channel. That's all I got for now. See y'all later.